U.S. President Donald Trump is facing fresh scrutiny after explosive financial disclosures revealed what analysts are calling an insane level of stock market activity tied to accounts connected to the U.S. president. According to documents released by the U.S. Office of Government Ethics, Trump-linked portfolios reportedly executed more than 3,700 trades in just the first 3 months of 2026, a staggering pace averaging nearly 40 trades every single day. The filings reportedly showed investments involving some of America's biggest corporations, including Nvidia, Tesla, Apple, Microsoft, Meta, Amazon, and Boeing. While there is currently no indication of illegal activity, the sheer volume of transactions has sparked massive debate across Wall Street and Washington alike. According to reports citing the ethics filings, at least $220 million worth of transactions were directly visible in the disclosures, but experts believe the true scale may be far larger because U.S. ethics forms only require broad value ranges instead of exact amounts. Analysts now estimate the total portfolio activity could have reached as much as $750 million, or nearly 560 million pounds. The documents reportedly revealed more than 2,000 purchases and around 1,200 sales, with heavy activity surrounding companies like Amazon, Meta, and Microsoft. Trump-linked accounts were also said to have repeatedly traded Nvidia shares throughout the quarter, adding even more attention to the already controversial disclosures. The revelations exploded online just days after Donald Trump traveled to Beijing for high-level talks with Chinese President Xi Jinping. The visit reportedly included top American business executives connected to companies like Tesla, Nvidia, MasterCard, and BlackRock, firms already appearing throughout the trading disclosures. That timing immediately fueled criticism from opponents, who argued that Trump's aggressive economic decisions, including tariffs and trade interventions, have repeatedly shown the power to move global markets within minutes. Critics are now questioning whether massive investment activity tied to the president creates the appearance of serious conflicts of interest. One of the strongest reactions came from Matthew Tuttle, the chief executive officer of Tuttle Capital Management, who reportedly described the scale of the trading activity as insane. According to reports, Tuttle said the volume looked less like a personal investment account and more like a hedge fund with massive algo trades, constantly buying and shorting securities. The comments quickly spread across financial media, with several analysts pointing out that even professional institutional investors would struggle to maintain such intense daily activity without highly automated systems. The controversy has now become one of the most talked about financial stories surrounding Donald Trump's return to the White House. Despite the growing backlash, the Trump Organization strongly denied any wrongdoing. According to statements cited in reports, representatives insisted that the investments were managed independently through third-party financial managers and automated trading systems. The company claimed neither Donald Trump nor members of his family were directly involved in day-to-day trading decisions. Meanwhile, White House spokesman David Engel dismissed concerns about conflicts of interest, insisting Trump only acts in the best interests of the American public. Engel also reportedly stated there were no conflicts of interest tied to the trading activity or the administration's economic policies. Still, the revelations are expected to intensify political pressure in Washington, especially as Trump continues shaping economic policy capable of dramatically impacting global markets, with billions of dollars potentially shifting in response to tariffs, trade negotiations, and presidential statements. Critics argue the optics surrounding the portfolio activity could become a major issue moving forward. For now, there is no evidence of criminal conduct, but the staggering pace of trades, the enormous estimated portfolio size, and the involvement of some of the world's biggest companies have already transformed the story into another major political firestorm surrounding Donald Trump's presidency. The controversy is also reigniting a much bigger debate in Washington over how closely America's top political leaders should be connected to the financial markets they directly influence. Ethics watchdogs and government transparency groups are now demanding greater reporting rules for high-ranking officials, arguing that broad reporting ranges make it nearly impossible for the public to understand the true scale of trading activity happening behind the scenes. Several critics have pointed out that even if the trades were handled through third-party managers, the U.S. president's public statements alone can send shockwaves through global markets within seconds. That reality, they argue, makes any large-scale investment activity tied to a sitting U.S. president automatically vulnerable to scrutiny, especially during intense economic uncertainty and global trade tensions. As the story continues dominating headlines, attention is now shifting toward whether Congress or federal ethics officials could push for deeper investigations into the disclosures. Financial experts believe the political fallout may only intensify if more details emerge about the timing of specific trades connected to major policy announcements or international negotiations. For Donald Trump, the controversy adds yet another high-profile storm to an already explosive second White House term. While supporters insist the president has done nothing wrong, opponents argue the staggering scale of the trading activity raises serious questions about transparency, influence, and trust at the very highest level of American power.